Hey there, this is Chris Creekmore Realty Group at the coast of North Carolina. And I am here with David Stokes. And I am always asked about different loan programs, and especially programs that are very attractive for those who are looking for retirement, primary retirement home. So David and I have worked together many times on many transactions, and I thought he could share some insight with those that are looking for alternatives and how to buy the most affordable home. So thank you, Dave, for being here with us today. And if you don't mind, share with us a little bit about who you are and what do you do?
Sure. Well, good morning, Chris, and thanks for having me today. Uh, I've been in the mortgage business since 1995, and during that time, I did financial planning, retirement planning for those in retirement, going in retirement. Now, all I do is mainly the what's called the Hecm for purchase loan. I'm a loan originator, originating loans for senior buyers to help them leverage the cash to help them buy the house that they want. I'm also the speaker for the North Carolina Department of Housing, where I educate realtors on this program throughout the state of North Carolina.
Okay, awesome. So I've had a pleasure getting to know you over the years, and have always found you to be just a great guy to work with, and very sincere in your interest to help your clients. So recognize that. If you would share with us, what is a Hecm?
Yeah, so a Hecm is it's an FHA loan. Hecm is an acronym for Home Equity Conversion Mortgage, and that's where the Hecm Purchase Program came about in 2009. It's a loan that's specifically designed for homeowners that are 62 and older to help them leverage the cash they have to buy their primary home with a one-time payment of roughly 45 to 65% of the purchase price. And what's unique about it, from there, no further mortgage payments are required, but of course, payments can be made at any time in any amount. And to help elaborate on that, what determines the amount of the one-time payment that's required from these buyers is the purchase price of the home, the age of the youngest borrower, because it's kind of based on longevity, and the interest rates at the time.
Okay, so this is a program that allows somebody to purchase a home without completely depleting all their cash. So let's say they're selling a house, I don't know, 500,000, and they believe that their best strategy is to take that $500,000 and roll it all into a house. But this is a program that allows them to not have to take all of that cash, so that they have money for maybe in addition to the house, or on a kitchen, or go on a vacation, pay a medical bill, what have you.
That's correct.
So who have you found is the best candidate for this kind of loan?
Yeah, I mean, I've been doing loans since 1995. I've been doing this loan since it originated in 2009. So the potential candidates for the program come in a variety of economic backgrounds. You start with my dad. My dad, has obviously been retired for a long time, has a decent stream of income coming in, but not a lot of assets. So when my dad decided to move to North Carolina to be closer to me about 12 years ago, he sold his house in Maryland, and from the sale, he got about $200,000 in his pocket from the sale of that home. Came to North Carolina, found a nice one-story, easy to maintain home. At the time, it cost about $235,000. So on his fixed income and limited assets, he didn't want to have a mortgage payment, and obviously didn't have enough to pay cash for the home. So the program allowed him to leverage his cash to make a one-time payment at the time of roughly $85,000, never have to make a mortgage payment, leaving him with $115,000 in his pocket to enjoy his lifestyle, travel a little bit, And what we also did was buy him a long-term care annuity. Now, on the totally opposite end of that, I have a lot of clients that are buying million dollar homes, and they could pay cash if they wanted to. But once they find out about the program, it helps them to, again, just leverage some of the cash they have in order to maintain more control of their money instead of locking that money up into their home. But I'd have to say the majority of buyers that use the program are a combination of the two I just mentioned. Most of our clients want to leverage the cash they have to buy the home they want with all the amenities they want and not have to use their funds or dip into their retirement money to buy their next primary house. They want access control of the extra cash to help them fund their financial longevity and lifestyle, basically.
Yeah, it's been a very good program and a very safe and secure program. Who, just to confirm, who's eligible for this? Let's say, my client is 65 and his wife is 58. Are they eligible?
They are eligible. So to qualify for the program, you have to be 62 and older, or in that case, married to somebody 62 and older. And you also have to have enough funds for the required one-time payment to buy the house. There's no debt to income ratio like there are with traditional loans. You basically have to have enough monthly income to pay your homeowner's insurance, your property taxes, HOA fee, and any other credit debt that you may have, credit card bills, car payments, and then have a residual income. So it's not a debt to income ratio situation. They have to have residual income. So it's very unique, and it's probably the easiest program to qualify for, again, because it's meant for people in retirement or going to retirement to help them have a better retirement, financial longevity in their lifestyle.
Gotcha. All right. So you came up with a little scenario for us on the leveraging and what that looks like. So let's share the screen and share this with our viewers, and bear with me. Okay. So the leveraging advantage. So talk to us about that.
Again, yeah, it's a really unique program because of the way you can use some of the cash that you have to leverage to buy a house. You can upsize or downsize with it, but it allows people to, again, use a one-time payment with the money they have to buy a house. Instead of being able to buy a house for the cash they have, they can leverage it to buy a house that's higher valued property. So you have a client that's 65 years old that has $329,800. This was an actual client. She had $329,000 in funds. She could buy a house for $329,000, all cash. All that money's gonna be locked up in house. She can't touch it. Or she could buy a house for $525,000 using the Hecm for Purchase loan program. And again, never have to make a mortgage payment. Now, for my dad, he's got that extra money in his pocket. He was able to buy a long-term care annuity. So he bought a $100,000 long-term care annuity. That annuity that I helped him buy, it triples in value immediately. So now he's got $300,000 in long-term care coverage, a house that is one story, safe for him to be in, easy to maintain, and no mortgage payment. Basically helping him to have very good cash flow in retirement. So, there are other options on what to do with that extra money, and that's a whole nother episode that we can go into. But like you mentioned, they can use the extra money to have fun, do some of the traveling they plan to do that didn't think they could do, participate in some of their hobbies, have fun with their grandkids, spoil their grandkids while they're alive. I had one client that helped fund their grandchild's college with the extra money that they have. So there's lots of different options. It's just as big as your imagination can be, is what you can use the money for.
So here's a common scenario that I experience here in Brunswick County which is again at the coast of North Carolina, just between Wellington and Myrtle Beach in North Carolina. So as we know, real estate values continue to climb. And they have most definitely climbed here in the Brunswick County because there's so many retirees who want to come to this area. So client is moving from New Jersey. They're going to get out $329,000 on their house that they're selling in New Jersey because they had some debt on that house. Let's say they sold it for 525, and then after paying the debt on the house, they net out 329. They say, Chris, I want to buy a house in the coast of North Carolina. I got $329,000. I want to be in a retirement community. I want to have a swimming pool and fitness center, a clubhouse, social activities, tennis, and pickleball, maybe golf, maybe not golf. But I want to be in a really beautiful community with lots of stuff going on. Great. So we look at everything that we humanly possibly can find for $329,000. But it's just not the right fit. And the reality comes into play that if I want to be in a community with all these amenities and all this infrastructure, which costs money by the developer, finding that exact house at 329 is a little tight. And so we need to stretch that budget just a little bit more such that they can get exactly what they want and live their retirement dream. And this Hecm for purchase gives them that flexibility to get the right house and not have to make a mortgage payment unless they want to. So your monthly expenses are not going out of whack because you also have to get a mortgage for that dream house.
Yep.
You are getting a mortgage, but not one that requires a monthly payment.
Right.
So did I walk that dog?
You summarized it very well. Yes. That's it.
Okay. So the next question that I have is, can you use this same program to buy a new construction house?
Good question. Simple answer is yes. You can use it. It's the same as basically buying a house that's existing, except for one caveat. So the one caveat is that the lender cannot order an appraisal until the builder has received and provided us with the CO, or the certificate of occupancy. Once we receive the certificate of occupancy, we've already underwritten the client. So that part's already done. Now we just have to wait for the appraisal, which we usually get within 5 to 7 days because there's a rush put on it. And then we're usually closing in about 10 to 12 days at the most from the time we receive the appraisal. But still, even with all that, we still close loans within 30 days. Because we're so far. What's that?
I have yet to find a builder that does not accept this as an option to purchase.
Right.
As long as they understand that the appraisal doesn't come until after CO, the builders understand it. And I've yet to find one that say, nope, not going to let you do that.
Right. Yeah, I've never had a problem with that either.
Yeah. All right. So what if I'm in my dream home and I've been there for 3 or 5 years, and my daughter in New Jersey has just had their 3rd grandchild, and they say, Granny, Grandpa, you're too far away. Will you please come closer to the kids? So what if if they need or want to sell in 3 to 5 years?
Yeah. So, in that scenario, it's no different than a traditional 30-year loan. If you decide to sell, then you would put your house up for sale with Chris. And from the sale, the loan gets paid back and the homeowners get the remaining equity. So they get to take that equity with them, just like they would for a with a 30-year loan. The one difference is that you would most likely walk away with more money, more equity, better cash flow in your pocket with the Hecm for purchase loan than you would a 30-year loan. If you think about it, the reason is that a 30-year loan mortgage, the mortgage payments, the first 15 years, you're paying mostly interest. And then after that 15 years, you're dipping into the principal more than you would the first 15 years. But the majority of your mortgage payment, those 15 years, is just interest. You're not paying down the loan. Where with the Hecm for purchase, even though the mortgage payment's optional, you because of putting down that large one-time payment, you're going to walk away with more equity, and most times than not, than a 30-year loan.
So there's really not a downside to this program, and if God forbid one spouse purchases or one spouse leaves this earth and the other one's there, their budget may get tighter for whatever reason. It's a non-recourse loan, so it doesn't nobody's ever forced out of their house.
Right. I'm glad you mentioned that. The Hecm is a non-recourse loan, and what that means is that the homeowners, the borrowers, are actually not responsible for the loan repayment of the loan like the 30-year mortgage. The home is the responsibility of paying back that mortgage. So if the borrowers leave the house to their heirs after they passed away, and somehow the loan is upside down, meaning the loan is higher than their home value, the heirs aren't responsible, and the lender cannot come after the heirs for the payment or any of the other assets that may have been left to the heirs. So that's one of the secure features about the program, that non-recourse feature.
So the appreciation rate in Brunswick County, because it continues to be top in the country for inbound moves. Yep. The appreciation rate has been over 4%, and in fact, it's been rather astronomical. But we imagine that we're going to have a little bit of a leveling off, and are starting to see that. But so all the time when I introduce this option to people, they say, it sounds too good to be true. So what's your answer for that?
Yeah, then with each client, it's because I get that, I hear that too. But with each client, it's different. What they, because I always ask them, well, what sounds too good to be true? Because I really can't answer the question without knowing what they, think is what's too good to be true. Couple of things to mention on that is that believe it or not, home loans were foreign to the majority of Americans before 1930s. If you didn't have the cash to buy a home, you're basically out of luck. So when the 30-year loan was introduced back then, I'm sure a lot of people thought it was too good to be true. But clients will say that often. And one of the features I want to point out about the program that often makes it sound too good to be true is when I tell clients, when you make payments to the loan, the mortgage payment that you make is going to be paying some of the loan balance, the interest. But unlike the 30-year mortgage where you never have access to those payments, the Hecm purchase loan program, when you make a payment, the money that you pay also goes into a line of credit. That's part of the program. It's in the background, nothing in it, and you're funding it with these mortgage payments. And then it gets even worse, per se, that the line of credit grows today at about 6.5%, 7%. So you have a client making a $1,000 payment a month into his loan. At the end of the year, he's going to have $12,000 in mortgage payments in the line of credit, and those funds grow annually today at about 6.5%, 7%. So a lot of my clients will put money in there, kind of preparing to take a trip or pay their property taxes and homeowners insurance, because they still own the house, so they're responsible for paying their property taxes and homeowners insurance. But instead of keeping it in the bank, some of my clients are making payments into their loan because of that tax-free growth rate. So that's why, it can sound too good to be true, but again, it's a loan that has to be paid back. So it's just like any other loan. It's a loan that has to be paid back. It sounds too good to be true, but it's an FHA loan that's been around, again, been around since 2009.
So if I have a couple that wants to purchase a property that's $525,000 and introduce them to you, you can do an amortization snapshot for them so that they can see where they're at 3 years, where they're at 7 years, where they're at 20 years.
Yep.
So it's completely disclosed so that they can plan. And if somebody did decide every quarter I'm going to put a little extra towards my loan, then that changes the amortization scenario, correct?
Yes, and actually we show up to age 100 for on the amortization page. So I'll show them what their loan's going to look like up to age 100 for the youngest borrower. And I can even show them, well, if you decide to make, $500 a month payments, $300 a month, or $1,000, whatever it is, I can show you what that'll look like, and it'll show what their line of credit looks like and that growth rate over time. So it's a great software to compare that to if they're even thinking about a 30-year mortgage, or even if they're thinking about paying cash, how they still have access to those payments in the line of credit, and it'll show what their home values look like and what the equity will look like overall each year up to age 100.
Doesn't the FHA require the couple or individual to go through a short course on the loan so that they fully understand what this loan program is about?
Yeah, and even though most of what I do is educational, HUD does require, FHA requires that they go to a HUD counselor, which I provide them a list of HUD counselors that they call around on, attend a 1 hour, can be over the phone session. Both borrowers have to be in that call to educate them about the program. Once I get done with my clients educating them, most of the time they'll come back and be like, well, that was a waste of time because you educated me fine. But I always like that they go to them, because maybe that HUD counselor will describe the program in a different way, or just say something that helps the clients to better understand the program. So I really like that there's that additional educational part to the program.
Yeah, I think that is too. And this program may not be right for everyone, but my point has always been, why not explore it?
Right.
And part of the exploration is taking that course, talking with you, and just to understand it. Does this work for me? Is this a scenario or a option that I should exercise?
Right.
Nothing more than that. Just trying to educate and show opportunities and options.
Yeah, because it is so much more than being able to leverage the cash you have, because there's so many other things that you can do to help solidify your financial longevity. That it's never described in the brochures or the pamphlets, because all these lenders are worried about compliance and saying too much or whatever. But that's where I come into play, because my financial planning background. I help clients to kind of navigate all those different options and tell them about it. When I do these talks for the North Carolina Department of Housing and mention all these other options, they were their eyes would get so big because they just didn't know all these options were available. But it's really the program that helps drive all these other opportunities for people going into retirement or in retirement.
So I wanted to bring you on, David, and thank you for taking the time to put this quick little interview together so that we could explain it a little bit better. And David's with Fairway Mortgage. He is just an outstanding guy, lives in Raleigh, North Carolina, although he is a Tar Heel fan. I've forgiven him for that. But anyhow, David, thank you so much for the time that you've shared with us. David's contact information is below. So please read David's bio. His phone number, his email is there. I highly encourage you to reach out to David, and he'll walk you through the process and just simply see if it's a scenario that works for you or
Yeah,
for the viewer.
Yeah, my pleasure, Chris. Thanks for having me on. It's always I love the opportunity to educate people in the program. So,
Excellent. So again, thanks all the viewers for watching this, and please call us. My contact information is below. Please subscribe to my YouTube channel, and we'd love to hear you and see you at the coast of North Carolina.
see you soon.